EPK Capital presents Deep Dive on Tata Motors. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Tata Motors. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. What if I told you that the company behind one of the world's cheapest cars is also the owner of one of its most luxurious brands? And that this same company went from losing nearly 29,000 crore rupees in a single year to posting a record profit of over 31,000 crore rupees just a few years later? This isn't a hypothetical. It's the incredible, complex, and captivating story of Tata Motors. But the crucial question for us as investors today is, after a spectacular multi-year rally, is there still value left on the table, or are the biggest gains in the rearview mirror? In this deep dive, we're going to dissect Tata Motors from every angle: its history, its financials, its valuation, and the powerful arguments from both the bulls and the bears. We'll break it all down, with no hype, just data. The Tata Motors blueprint, from trucks to tech. To understand Tata Motors, one must first understand the institution it belongs to. The House of Tata, a legacy of trust. Tata Motors is not a standalone entity. It is a flagship company of the Tata Group, a global enterprise founded by Jamsetji Tata in 1868. The principal promoter and holding company is Tata Sons, which holds a significant stake of over 42%. What makes this structure unique is that 66% of Tata Sons' equity is held by philanthropic trusts, which support education, health, and art. This foundation instills a corporate ethos focused on nation-building and long-term stakeholder value, a stark contrast to companies driven solely by quarterly performance. The strategic alignment is further cemented by the fact that the chairman of Tata Sons, Mr. N. Chandrasekaran, also chairs the board of Tata Motors. This backing provides immense brand equity and a stable, long-term strategic outlook. A century in motion, the evolution of an industrial giant. The company's journey began in 1945 as Tata Engineering and Locomotive Company, or TELCO, initially manufacturing steam locomotives. A pivotal moment arrived in 1954 with a collaboration with Daimler-Benz to produce commercial vehicles, a move that laid the groundwork for its eventual dominance of India's truck and bus segment. For decades, Tata was synonymous with commercial vehicles. It wasn't until 1988 that it ventured into passenger vehicles with the Tata Mobile pickup truck. This was followed by a series of pioneering products for the Indian market: the Tata Sierra in 1991, India's first indigenous SUV, and the iconic Tata Indica in 1998, the country's first fully indigenous passenger car. This history reveals a corporate DNA rooted in engineering and self-reliance. This engineering-first mindset, developed over decades of creating products for India, is a direct precursor to its current leadership in the electric vehicle space. The willingness to pioneer new segments, as seen with the Sierra and Indica, provided the cultural and technical foundation to move decisively into EVs with products like the Nexon EV, capturing a dominant market share while legacy competitors were still in the planning stages. The company's ambitions soon turned global. The most transformative move was the high-stakes acquisition of the British luxury brands Jaguar and Land Rover, JLR, from Ford in 2008. This single act fundamentally altered the company's identity and risk profile, instantly turning it into a major player in the global luxury market. This bet-the-company decision created a long-term duality in its business model. An investor in Tata Motors today is simultaneously exposed to the Indian economic cycle through its domestic business and the spending habits of the global luxury consumer through JLR. This diversification is a strength, but it also introduces a complex web of risks. The modern machine, three engines of growth. Today, Tata Motors operates through three distinct and powerful business segments: Jaguar Land Rover, JLR. This is the crown jewel and the primary profit engine of the company. It contributes the lion's share of revenue, accounting for around 71% in the first 9 months of fiscal year 2025. JLR is home to two iconic British brands: Jaguar, known for luxury sedans and sports cars, and Land Rover, the undisputed leader in premium all-terrain SUVs like the Defender and Range Rover. Tata Commercial Vehicles, CV. This is the company's original backbone and India's market leader in trucks and buses. With a retail market share of 39.1% in fiscal year 2024, this segment's performance is often seen as a barometer for the health of the Indian economy. Tata Passenger Vehicles, PV, and Electric Mobility, TPM. This is the high-growth domestic business. Tata Motors is currently among the top 3 passenger vehicle players in India. Crucially, this segment houses Tata Passenger Electric Mobility, TPM, which has established a commanding leadership position in India's nascent but rapidly expanding EV market. The financial X-ray. A decade under the hood. The financial journey of Tata Motors over the past decade has been nothing short of a roller coaster, marked by deep troughs and record-breaking peaks. The revenue and profit roller coaster. Looking at the consolidated financial statements, sales have shown a steady climb, growing from Rs 232,834 crores in fiscal year 2014 to Rs 439,695 crores in fiscal year 2025. However, the real drama unfolds in the net profit line. After a period of stable profits from 2014 to 2018, the company plunged into heavy losses. The period between fiscal years 2019 and 2022 was brutal, culminating in a staggering loss of Rs 28,724 crores in 2019. This was the result of a perfect storm: Brexit-related currency headwinds and market uncertainty hurting JLR, the fallout from the Volkswagen emissions scandal impacting diesel vehicle sales, a key strength for JLR, and a slowdown in the domestic Indian auto market. Just as things looked bleakest, a sharp, V-shaped recovery began. The company turned profitable in 2023 and went on to post a record net profit of Rs 31,807 crores in 2024. This remarkable turnaround was engineered by JLR's Reimagine strategy, which focused on profitability over volume, coupled with easing supply chains post-pandemic and soaring demand for its high-margin luxury models like the new Defender and Range Rover. Conquering the debt mountain. During the loss-making years, the company's debt burden became a major concern for investors. Consolidated borrowings ballooned from Rs 60,642 crores in 2014 to a peak of Rs 146,149 crores in fiscal year 2022. This high leverage increased interest costs and magnified financial risk. However, the recent profit surge has been accompanied by a strong generation of free cash flow. JLR alone reported a record free cash flow of $2.3 billion in fiscal 2024, allowing it to become net debt zero. This has enabled a dramatic deleveraging of the parent company's balance sheet, with borrowings falling to Rs 71,540 crores by fiscal 2025. This strengthening of the balance sheet is a critical part of the bull case, as it reduces financial risk and frees up capital for future investments. Profitability, deep dive. Margins. A key indicator of operational health is the operating profit margin, or OPM. This metric shows how much profit a company makes from its core operations before interest and taxes. Tata Motors' OPM fell from a healthy 15% in 2014 and 2015 to a low of 7% in 2021. The recent turnaround has seen this margin recover strongly to 13% in both 2024 and 2025. This demonstrates that the recent surge in profits is not just due to higher sales. but is a high-quality recovery driven by a better product mix, disciplined cost controls, and improved operational efficiency. The market's pulse, a technical perspective. A company's stock chart is more than just lines and numbers. It's a visual story of market sentiment reacting to the company's fundamental journey. The multi-year journey on the chart. Looking at a long-term price chart of Tata Motors, the narrative mirrors the financial turnaround perfectly. The stock was in a brutal downtrend from 2018 through the lows of March 2020, battered by the financial troubles discussed earlier. Then, coinciding with the first green shoots of the operational turnaround, the stock began an explosive, multi-bagger rally from its 2020 lows. Over 5 years, the stock has delivered a staggering return of over 422%. More recently, after hitting an all-time high of around R1,079, the stock has entered a period of consolidation or sideways movement as the market digests the massive gains and evaluates what comes next. This price action is a classic example of how market sentiment eventually aligns with business performance over the long term. Mapping the territory, support and resistance. In technical analysis, support is a price level where buying interest is typically strong enough to prevent the price from falling further. Resistance is the opposite, a level where selling pressure tends to halt a price rise. For Tata Motors, technical analysts are watching a few key areas. There is a significant support zone identified around the R630 level. A break below this level could signal further weakness. On the upside, a key resistance area is noted between R740 and R760. A decisive move above this zone would be seen as a bullish signal, potentially indicating a continuation of the primary uptrend. The momentum gauge, RSI. A popular tool to gauge momentum is the Relative Strength Index, or RSI. It's an oscillator that moves between 0 and 100. A reading above 70 is typically considered overbought, suggesting a rally may be due for a pause, while a reading below 30 is considered oversold, suggesting a decline may be losing steam. Currently, the 14-day RSI for Tata Motors is in the mid-range, with readings around 48 to 55. This neutral reading indicates that the stock is neither significantly overbought nor oversold. It suggests a state of balance in momentum, which aligns with the recent consolidation seen on the price chart. The value investor's calculation. Is Tata Motors Graham certified? To assess the stock from a classic value investing perspective, we will apply a formula developed by the father of value investing himself, Benjamin Graham. We'll use his famous Graham number, a conservative measure designed to determine the maximum price a defensive investor should pay for a stock. Calculating the Graham number. The formula is straightforward. Graham number, 22.5x earnings per share, EPS XX book value per share, BVPS. 33. Let's break down the components. 22.5. This constant is derived from Graham's two key rules of thumb. A stock's price to earnings, PE ratio, should not exceed 15, and its price to book, PB ratio, should not exceed 1.5. Multiplying these two limits, 15x 1.5, gives us 22.5.34. Earnings per share, EPS. This is the company's profit allocated to each outstanding share of stock. We will use the trailing 12 months TTM EPS, which stands at R57.25. 1. Book value per share, BVPS. This represents the net asset value of the company on a per-share basis. The latest reported BVPS is approximately R315.1, the verdict. According to Graham, the calculated Graham number is approximately R639. We compare this to the stock's recent market price of around R681.36. Since the current market price is higher than the Graham number, this highly conservative valuation metric would classify Tata Motors stock as overvalued. However, it is crucial to understand the limitations of this formula in the context of a company like Tata Motors. The Graham number was designed for stable, industrial-era companies with predictable earnings and tangible assets. Its core components fail to capture two of the most significant value drivers for modern Tata Motors. First, the book value, BVPS, primarily reflects physical assets like factories and machinery. It does not adequately account for the immense intangible value of the Jaguar and Land Rover brands, which command premium pricing and global customer loyalty. Second, the trailing EPS does not price in the future growth potential of the electric vehicle business, which is expected to grow exponentially and is often valued more like a technology company than a traditional automaker. Therefore, while the calculation is a useful exercise in conservative valuation, applying it rigidly here may provide a distorted picture. It serves as a powerful reminder that no single formula is a silver bullet, and understanding a tool's limitations is as important as the calculation itself. The investment thesis: bulls versus bears. Now, let's distill all this information into the core arguments for being optimistic and pessimistic about Tata Motors' future. The bull case: reasons for optimism. 1. JLR's sustained profitability. Jaguar Land Rover has transformed from a financial drag into a powerful profit engine. It has achieved record profits, is now net cash positive, and continues to see strong global demand for its high-margin luxury models like the Range Rover and Defender. 2. Dominance in India's EV revolution. Tata Motors has an undisputed first-mover advantage and a market-leading share of over 50% in India's booming EV segment. With a pipeline of new models like the Sierra EV and Harrier EV, and a stated goal for EVs to constitute 30% of its sales by 2030, the company is perfectly positioned to capitalize on this multi-decade growth trend. 3. Fortified balance sheet. The aggressive reduction in debt has fundamentally de-risked the company. Lower debt translates to lower interest payments, which directly boosts net profits and provides greater financial flexibility to invest in future growth areas. 4. Value unlocking from demerger. The company has announced a plan to demerge its commercial vehicles, CV, and passenger vehicles, which includes the domestic PV business, EVs, and JLR, into two separately listed companies. This move could unlock significant value by allowing investors to invest directly in either the high-growth PV/EV JLR story or the stable cyclical CV business, potentially leading to a higher combined valuation for the two entities. The bear case: reasons for caution. 1. Over-reliance on JLR and cyclicality. The company's profitability is heavily dependent on the health of the global luxury market. This market is highly sensitive to economic downturns, geopolitical tensions, and trade tariffs. A recession in key markets like the US, Europe, or China could severely impact JLR's sales and Tata Motors' bottom line. 2. Intensifying EV competition. While Tata is the current leader in India, its market share has already started to decline from its peak of over 70% as new competitors enter the fray. Domestic rivals like Mahindra and global giants like Hyundai, BYD, and eventually Tesla are launching competitive products, which will inevitably pressure both market share and profit margins in this crucial growth segment. 3. Input cost and supply chain vulnerability. The automotive industry is highly susceptible to fluctuations in raw material prices, from steel and aluminum to key battery components like lithium. A sharp, sustained rise in battery cell costs, for example, could erode the profitability of the EV business and challenge its price competitiveness. 4. Execution risk. The company is juggling several massive and complex transitions at once: the complete electrification of the JLR portfolio under the Reimagined strategy, the rapid scaling of its domestic EV business, and the intricate process of the corporate demerger. Any significant missteps in executing these large-scale projects could derail the growth story. The central tension in the investment case is a race. The bull case relies on the high-growth EV business scaling up fast enough to command a high valuation for the entire company. The bear case fears that a cyclical downturn in the JLR business, which currently provides the bulk of the profits, could cripple the company's financials before the EV business is large enough to compensate. The upcoming demerger is management's strategic answer to this very tension, aiming to let the market value each business on its own merits. The final checks: scandals and stature. A complete analysis must also consider a company's governance history and its place in the world. Corporate history check: acknowledging the past. While Tata Motors today operates with a robust governance framework, it's important to acknowledge two major controversies from its past. The Singer Nano Project, 2006-2008, a significant dispute over the process of land acquisition for the Tata Nano factory in West Bengal led to intense political and social protests. This ultimately forced the company to relocate the entire project to Gujarat. Years later, the Supreme Court of India ruled that the initial land acquisition was illegal. The episode remains a landmark case study in industrial land acquisition in India. The Cyrus Mistry ouster, 2016. The sudden removal of Chairman Cyrus Mistry from the board of Tata Sons triggered a bitter and highly public legal battle. It raised questions about corporate governance and the influence of the promoter group. While the courts ultimately sided with the Tata Group, the episode brought governance practices under intense public and legal scrutiny. These events are part of the company's history and have shaped its modern governance policies, which are now extensively documented and aligned with global standards. Global market position, a seat at the high table. Today, Tata Motors is a formidable player on the global stage. It is a Fortune Global 500 company. Driven by the strong performance of JLR and its domestic businesses, its market capitalization recently surged, placing it among the top 10 most valuable automotive companies in the world, at times surpassing legacy giants like Ford and General Motors. With a vast global footprint that includes operations and sales across North America, Europe, Asia, and Africa, Tata Motors has cemented its status as a true Indian multinational. The final word. So, what is the final verdict on Tata Motors? It's a company of fascinating contrasts, a story of a historic turnaround powered by the roaring success of its British luxury brands, a domestic champion that has become the undisputed king of India's EV hill, but now faces a wave of new challengers. Its financials are the strongest they've been in a decade, with its debt mountain largely conquered. Yet its fortunes remain closely tied to the whims of the global luxury consumer. The bull case points to a future of EV dominance and value unlocking through its planned demerger. The bear case warns of intense competition and the inherent risks of the cyclical auto industry. As we've seen, a simple valuation metric like the Graham number suggests caution, but it may not capture the full story of brand value and future growth. Ultimately, the path forward for Tata Motors depends on its ability to flawlessly execute its ambitious EV and luxury strategies while navigating a complex and uncertain global landscape. The data and analysis presented today are designed to give you a comprehensive framework to form your own informed opinion. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.